Imagine waking up, making breakfast, exercising, and enjoying a stress-free day with family, all while your money earns a full-time salary for you. It sounds impossible, but it really comes down to one question. How much do you actually need in the bank to stop working? Today we're taking a closer look at 3 investment options that can create long-term financial stability and in some cases generate enough passive income to support your entire lifestyle. Most people assume financial freedom requires you to be ultra rich, but in reality it's about replacing the income you need with income your money generates for you. And once you understand the numbers, the path becomes much clearer. Investment number 1, certificates of deposit. These are one of the safest and most predictable ways to earn passive income. Think of CDs as loaning your money to the bank for a set period. This could be 6 months, 1 year, even 5 years. In return, the bank pays you a guaranteed interest rate. The best part? CDs today are offering up to 3 to 5% returns if you shop around. These aren't stock market returns, nor are they tied to risk, volatility, or luck. It's guaranteed income backed by FDIC insurance. Let's crunch some numbers. If you have $50,000 in a CD, earning around 5%, you'd receive roughly $2,500 every year, completely passively. Now let's say you decide to put $250,000 in a CD. This is normally the max per CD. Earning around 5%, you'd receive roughly $12,500 every year. It is a cool concept when you think about it. Now, if you want to live off CD interest, you first need to figure out your living expenses and other habits. That being said, if you put $1 million across a range of CDs, earning 5% interest, you would receive a whopping $50,000 a year. That is what a lot of people make in 1 year, and you will earn it completely passively. Your principal stays intact, income stays steady, and your lifestyle becomes more predictable. Now realistically, unless you have $1 million sitting around, CDs won't make you rich, but they can cover a large portion of your core expenses. Just think how many groceries, utilities, and insurance bills you could cover without you ever touching your savings. The only disadvantage of CDs is the liquidity aspect. This is how easy it is to withdraw the money. All of the examples we showed you were 1-year CDs, so that means you would need to keep the money in the bank for at least 1 calendar year. However, this next investment gives you the same returns and you can withdraw the funds instantly. Investment 2 is a high-yield savings account. If CDs are your long-term parking spot, think of high-yield savings accounts as your everyday driver. They pay similar interest rates to CDs, are stable, but high-yield savings offer full liquidity. You can withdraw your money anytime with no penalties while still earning high interest. High-yield accounts give you freedom to cover emergencies, relocate, adjust your lifestyle, and to sleep at night knowing your money is FDIC insured and accessible. Looking at the returns, it works the same as a CD. A high-yield savings account earning 5% on $500,000 generates about $25,000 per year without touching the principal. Now, let's one-up the CD example. A high-yield savings account earning 5% on $2 million will earn you a staggering $100,000 yearly. That is enough to live, take care of others, and even splurge from time to time. But once again, you need the $2 million to start with. It's difficult, but not impossible. Strategy-wise, some people combine CDs and high-yield savings accounts for a blend of higher guaranteed returns and full liquidity. It's a cash-based passive income strategy for someone with low expenses and simple tastes. This alone can create the foundation for a work-optional lifestyle. Now the next investment not only will pay you returns, but the investment itself has an opportunity to increase as well. Investment 3. Dividends and ETFs. This is the option with the highest potential for long-term passive income. Unlike CDs and savings accounts, dividends come from owning shares in actual companies. Then those companies generate profits and share a portion of those profits with their investors. These profits are called dividend yields and usually fall between 2 and 5%. But the real power comes from two things: dividend growth, which causes your income to rise over time, and stock appreciation, which causes your principal to grow with the market. A balanced portfolio of dividend stocks have historically returned around 7 to 9% annually. That means a $500,000 portfolio could generate $35,000 to $45,000 per year. Let's look at a real-world example. The famous Coca-Cola company, also known in the market as the symbol KO, has been one of the most consistent dividend-paying companies and have consistently awarded shareholders with payouts dating all the way back to 1987. Their most recent dividend payout at the time of this video was on September 14th of 2025. If you owned one share of Coca-Cola, you would have earned 51-cent dividend by doing absolutely nothing but owning the stock. It may not sound like a lot, but the payouts will add up to bigger returns. To prove this, if you own 10 shares, you would have earned $5.10, and 20 shares would get you $10.20, and so on. Financial freedom isn't about being ultra rich. It's not about chasing luxury or hitting a magic number. It's about creating enough stable income, whether through certificate deposits, high yield savings accounts, or dividends, to support the life you actually want. True wealth is choice. True wealth is time. True wealth is freedom. And with the right investments, you can earn all three. Be sure to hit the like button, subscribe to the channel, and turn on that notification bell. We post weekly reels and new videos on Fridays. Thank you all for watching. Remember to always save smart and invest smarter.